What if I told you that putting $10 into this stock right now could turn into $1,000? You probably call me crazy, but you're the one that's actually incorrect. So we're going to cover a huge opportunity in a stock that I am very passionate about and that I am building a $30,000 position into, Lululemon Athletica Incorporated, also known as Lulu, the ticker symbol. So the stock dropped 19.8% today. And of course, when you go on YouTube, you're going to see everybody panicking because the average YouTuber and the average investor only likes to see stocks going up. I disagree. I love when stocks go down because that gives me an opportunity to purchase a powerful, growing business at a low price and valuation in order to make a large return into the future. And I believe Lululemon is one of those opportunities. So let's go ahead and look at the earnings that they just released. We're going to go look at the financial statements from the past, and then we're going to use my exciting DCF tool known as 10,000x equities that you can use to provide rational valuations and potential, and I emphasize potential, buy points for stocks. So Lululemon is an athletics company. Now, if you have a girlfriend, you've probably heard of, women going to the gym and wearing Lululemon products. They're very high quality, mostly athletically aligned apparel. And it's not just in the United States, it's actually an international brand. And I would argue that the strength of this business is that it has a rapidly growing international presence, and it's still growing in the United States. So if we go look at the Q1 2025 earnings, they just released this earnings commentary. Total net revenue increased 7% or 8% on constant dollar basis. Total net revenue was $2.4 billion in Q1 2025 compared to $2.2 billion in Q1 2024. So their revenue is still growing at a 7 to 8% clip. This is an apparel store. This is massively outperforming inflation. Remember, we have tariffs, we have trade drama, and still this company is growing its revenues. Now, America's revenue increased 3 to 4% on a constant dollar basis. China mainland net revenue increased 21%. 21%. This is a powerful growth stock. But what Wall Street is doing, and they're making a huge mistake here, in my humble opinion, is they're only focusing on U.S. sales because America's net revenue was $1.7 billion. That's the vast majority of this company's revenue right now. As a matter of fact, it's exactly 71% of their total revenue. The America's revenue is growing roughly at the pace of inflation. And remember, this is during bad economic times and a trade war. If you look overseas, you can see that it's growing 21% in China with total net revenue of $368 million. And in the rest of the world, outside of the Americas and China, it's growing at 16%. That is astronomically high growth. So, 16% of their revenue comes from China, and 14% comes from the rest of the world. That's 30% currently, rough 30% of their revenue. What do you think is going to happen when China and the rest of the world continue to grow, and they're growing faster than the United States? The revenue of this company is going to explode. On top of that, the United States is about to have a massive tax cut. We have the big, beautiful bill that Donald Trump is going to pass. What do you think that's going to do to Americans' purchasing power? They're going to have a lot more money after tax time. And guess where they're going to put the money? Into gifts, athletic apparel, items that are on the higher end, that are perceived as higher end, like Lululemon. So they're massively growing revenue in China and the rest of the world. In the United States, revenue is growing slower, but we're about to have massive fiscal stimulus when we get the tax cuts with the big, beautiful bill, and they're opening new stores. As a matter of fact, at the end of Q1 2025, they had 770 total company-operated stores compared to 711 the prior year. They've opened 59 stores in a year. They've grown their stores almost 10% in a year. When you look at profitability, their gross profit, this is their profit right after revenue. This is the profit they get from selling the items. It was 58%. That is an insanely high margin. 58% of their revenue is gross profit compared to 57% last year. They increased their gross margin. So they're growing revenues massively overseas. Their revenues will be turbocharged in America in the next couple of quarters once the tax cuts go into effect, and they're increasing their margins. And this is all during a trade war in a period of higher inflation. But inflation is trending down. Tax cuts are coming. How can this company possibly lose? Now, Wall Street, I suspect, is a little concerned about their selling, general, and admin expenses. Their SG&A expenses were 39.8% of net revenue in the most recent quarter, compared to 38% in the prior year. However, this is due to some one-off charges, and they can quickly batten down on their selling, advertising, general, and administrative expenses and massively increase their profits. Their operating income was 18.5%, a slight drop from 19.6% because of one-off charges. So, I'm telling you right now, Wall Street is overreacting to Lululemon selling off. Now, I want to point something else out to you. Let's look at the chart here. Lululemon tends to go through periods of rapid stock price appreciation and then a collapse in the stock price. Where do you think we're at right now in that trend? The stock is collapsing. I'm going to start nibbling with the 30K, and then I have 70 more K that I'm potentially going to throw in. When the stock bottoms, which it probably will if you look at the chart, around 250, I'm going to go all in at that point and have $100,000 invested in this stock. And then when it doubles very quickly, which it does all the time, I'm going to make an absolute fortune. Now, let's use the discounted cash flow tool that I designed and that you can purchase. You can actually purchase this tool for a one-time fee of $30. See the pinned comment below. We're going to punch some numbers into this tool and see a good potential buy point for the stock. And you're probably going to be surprised it's already there. So all you have to do for this tool, once you purchase it for $30, and you never have to pay another cent again, it's a one-off charge, you can put in the time period for the DCF. We're going to do a 10-year analysis. You put in the trailing 12-month revenue, which is $10.7 billion. I pulled that directly from stockanalysis.com. You go to trailing 12 months, and you see the trailing 12-month revenue right here. That's the last 12 months of revenue. And then you pull the shares outstanding, which are also on here, right here, 122 million. And you plug that into the discounted cash flow. And then the rest is just your inputs and your assumptions about future revenue growth and profitability. So I believe Lululemon is going to grow their revenue at approximately 7, let's go with 8%. Because as, China and the rest of the world become a bigger percentage of the company's total revenue, I think their revenue is going to reaccelerate. Their profit margin we saw in the most recent earnings was 20% roughly. Their free cash flow margin, which is their profit, their cash flow minus their capital expenditures, is also roughly 20%. I believe their price to earnings ratio in 10 years for such a strong, powerful growth company with a large moat and large appeal with half of the population is going to have a price to earnings ratio of 30 and a price to free cash flow of 30. My discount rate or my required rate of return is going to be 12%. I want to beat the market. And they're going to buy back shares, in my humble opinion, at roughly 2% per year. The buy point, according to my discounted cash flow, and these are just my assumptions. You have to put reasonable assumptions that you think work for you. And this doesn't guarantee that you're going to make a profit. My buy point is $606. Where is this company trading now? $265. Very interesting. What is Wall Street missing? They're taking the short view. They're worried about margins and they're worried about trade wars and they're worried about China. China's not going anywhere anytime soon. United States is about to have massive fiscal stimulus, and this company is going to rocket back up like you've never seen before. And you can even look at the chart and see this is the same story. The stock sells off, it bottoms at about 250, and then it rockets back up for an easy double. An easy double. So let me know what you think. If you want to purchase this discounted cash flow tool, it's $30 one time. You can use this infinite amount of times. You can put in whatever assumptions you want. You can change the profit margin to 12%. You can change the price to earnings ratio to 25%. You can play with the numbers to kind of see what you think is a good point to potentially buy this stock. Of course, this is not financial advice. You should do your own due diligence. And this tool does not guarantee success. It is simply a discounted cash flow tool, but I find it useful. Anyway, like, subscribe, tell your friends about me. Consider joining the membership where I do exclusive content. You'll really like it, I think, and have a wonderful night.